Good afternoon, everybody. I'll give everyone 30 more seconds before we kick off just to join the call, and then I'll officially take over. All right, welcome everybody. As we get started, I'd like to begin by acknowledging the traditional owners and custodians of the land on which we meet today, the peoples of the Kulin Nation. I also pay my respects to their elders past and present. So as we kick off today, welcome again. This is webinar 2 of the capital raising series that we're running for our Victorian companies out there. So I'll introduce myself. My name's Adrian Percy from Global Victoria. I'm the Senior Trade Managers for the Americas. And I'll make the general assumption that most of you on the call today probably were part of the first webinar we held 2 weeks ago. So I won't go too much into the background information, but enough to know that we work with a lot of Victorian companies seeking to go to the US, and capital raising be a very key factor in their expansion plans, and hence why we're putting together this webinar series. So with that, today's session is really centered around preparing to raise and how giving insights as to how companies should be thinking and the important things to consider when they're looking to raise capital. Now, just a couple of little housekeeping things to run through quickly. If I could get everyone to ensure that their mics are off, and everyone other than Paul, Anthony, and Abby, everyone else have your video off as well. Just running through a little bit of the format, I will hand over to Anthony in a minute to introduce the others, and we'll run through the session. So after the introduction that Anthony will give, he'll jump over to Paul for the actual presentation session. And in an ideal world, we have a good 10 minutes towards the end of the session for question and answers. So with that, if I could introduce Anthony Curtin from Merton Lawyers. So Anthony has been essential in helping put on this webinar series. So I did, for those on the call, call him out on the last webinar, but he was on a plane at the time, so couldn't answer. I know that's no excuse, but that was the excuse he gave me. But Anthony, we work very closely with a number of key partners at Global Victoria, and Anthony from Merton Lawyers has been critical in a number of works that we've done, and pulling together this series. Not only has he helped in terms of the content, but also bringing some very key high-level stakeholders to the table to deliver some of that very important content. And today, obviously, he'll introduce Paul, Naphtali, and Abby in terms of their interest in Rampersant and get the program started. So, Anthony, I'll hand over to you, and if you could go and introduce the team for me.
Thanks, Adrian. And yeah, look, and thanks for that really very kind intro. Yeah, unfortunately, I couldn't make the last webinar series. As glamorous as it might seem that I was on a plane for work and flying all over the world, I was actually navigating my 3-year-old, changing nappies and stuff on a plane. So it wasn't as pretty as it sounds. But no, thank you very much for that, Adrian. And likewise, like, you've been an amazing resource to a number of our clients and investor clients as well that are looking at the US. You've got such a pragmatic, practical, and commercial lens on. And Adrian's been amazing. If there are any people on this call that are looking at the US. I mean, it's such a great resource, and we're so fortunate to have someone on the ground here that can assist with that expansion and also on the ground in the US as well. So yeah, look, thanks Adrian for that, and thanks to the wider Global Victorian team, for giving us the opportunity to assist with curating this webinar series. It's been a real privilege. I'm not sure if many people know about Merton. We advise founders and investors of emerging growth companies through the whole life cycle, and we do a lot of work in the US, helping Australian founders and companies land more successfully through our Project Frontier program. So we can talk about that at another time, because it is, with great pleasure to welcome you all today, and especially welcome our speakers, Paul Napthali, who is the co-founder and CEO of Rampersand, and Abby Marand from Rampersand as well. Not sure if what background you all have, but Paul is one of the co-founders of Rampersand, which is an early stage Australian tech fund. It was founded in 2013, which was there to help address really the funding gap for Australia and New Zealand seed and pre-seed founders. And if you think back to that stage, that was a really unique period of time to be a strict VC, and so we do have one of the real leaders here. A lot of this was established after a decade working in the UK and Silicon Valley in senior marketing and strategic roles with high growth startups, a number of them backed by Sequoia and other top tier US and European VCs with exits to Facebook, Telefonica and Oracle. Paul and I have really connected over the last couple of years, obviously from a commercial standpoint and also just from a understanding the market. But I think, there's a lived shared purpose that we have of really lifting up the Australian ecosystem. And as much as Paul's got a great CV and is one of the leaders in the ecosystem, he's a wonderful educator, and we're really grateful to have you here today, Paul. Abby, I'd also like to welcome. Abby, he did get pulled in a bit late because we really realised how much knowledge he has. And I did meet him for the first time recently, and I'd like to summarise his work, but honestly, I went through his LinkedIn and it was just, I just didn't have that much time. But I must say, if you've got the chance, go and have a look at it. It's very impressive. He's worked with a number of investors and tech companies and founded a number of his own groups. He's been on both sides of the table, pitching an idea, reviewing a pitch, or being pitched to. So we're in really good hands. This is going to be a great session. I hope everyone really enjoys today. In terms of any questions, please put them into the Q&A section. We will, where appropriate, ask some of these questions and hopefully bundle them up. We have had an enormous amount of people register for these sessions, and we hope to, obviously answer as many questions as we can, but we want to make sure that we get through the content. But if there are any specific questions, we will have contact details at the end. But Paul, Abby, over to you. Really looking forward to this, and be a great session.
Great, thank you. It's a lovely introduction, Anthony. I want you to come and do my next investor presentation intro, please. And thanks, Adrian, for organising this and for having us on. As Anthony said, I've asked Abby to join, particularly because he's got a wealth of knowledge and experience on this topic, which is helping founders get ready to raise. It's one of the things we spend a lot of time doing. And when we put our slides together for this, I was looking through the best content is actually from Abby, so that we'll actually, rather than me try and take his words through my mouth, we'll have him come and present to you directly. I'll give him a bit of a plug. If you don't follow him on his content already, it's very much worth you doing it. He's very generous with the amount of knowledge he shares. You're going to get a lot of it today, but it's also very dynamic, some of this information. It's not, and this is not a static world. So he's got one of the most followed, if not the most followed, Substacks in Australian venture. He's not very big on the self-promotion. You can probably see him being a bit shy about what I'm saying, but just as a founder, highly encourage us, just find him and his content feeds and subscribe. You will learn a huge amount. And of course, if you're looking to talk to any early stage investors in this country, whether it's to bounce ideas or learn, or for raising capital, we spend a lot of time on all of those. It's not just about deploying money; it's about actually growing this ecosystem, as Anthony said. So we're going to split this into a few pieces. I'm going to talk to a few slides on who we are. I think context is really, really important. Everyone's got a point of view. One of the family sayings in my household is we're always confident, we're just not always right. So it's really important that you know there is no absolute truth. There is only a perspective, and I want you to hear what our perspective is. Why we share this with you is really important. It's not to say that everything you're going to be here today is actual facts and law. So we'll share a few slides on so who we are and where we're coming from. Then Abby's going to talk a bit about some specifics on the fundraising process and the topic of preparing to raise. He's going to have slides that we'll talk to. There'll be data on there. We're happy to share this afterwards, Anthony and Adrian. So I think you've got copies of them, but really happy for you to share, or if they don't come through, just get in contact with us. And as Anthony said, and Adrian before him, we really do encourage Q&A. We can't tell what your questions are. This is an industry and a particular stage of an industry which is really opaque. There's lots of buzzwords, there's lots of bullshit, quite frankly, and you'll hear terms. So it's really hard to know what these things mean. And we live in it day to day, so we sometimes even slip into it ourselves. So we really encourage you, if you've got questions at all throughout the presentation, please stick them in the chat. I think Anthony and Adrian, you're going to monitor that. We'll try and keep an eye on it as well, and we'll really try and do our best to cover everything in the hour to make sure that we're covering what you want to hear. So, Abby, can you check the slides up? So just to set a bit of context, Rampersad, we're an early stage fund. What does that mean? We'll do seed, pre-seed deals. Typically, what we're looking for when we're talking to founders and writing checks is that there is a founding team in place. There's probably the initial prototype, or there's some technology that has actually been built, and you've either got your first customers or you're on the verge of getting your first customers. So we don't tend to do sort of back of a napkin stage companies, meaning you've got a business plan but nothing else. But we do love having discussions with you at that point. Just want to say that there's so much misinformation. So if you're wondering whether it's too early, I think Abby, you're going to touch on this. Have the conversation, understand what our perspectives are. We feel very, very strongly as an investor in this market, so we invest only in Australia and New Zealand, that having a better educated, better informed, better prepared founder community is critical to our success as an ecosystem and as a fund. So don't die wondering. There is no too early. When founders think that they've got to wait for that moment to come to us and say, well, I've got the perfect pitch, it doesn't exist. When people come and say, we've never made a mistake, you're uninvestable. Don't be afraid. So we focus at that stage. We'll write checks. I think the smallest first check we've ever written is 150 grand, up to $2 million as a first check. But as a fund, what we'll also do is reserve money to follow on. It doesn't mean that next check is guaranteed. It just means all things going well, we want to keep funding you. We have our own investors. We have 157 investors. They're all private families and high net worth individuals, as well as operators, founders, and people from the tech community. We focus almost exclusively, but not exclusively, and I'll explain why, into what's written on that slide there. So business software, digital marketplaces, and data-driven sort of AI automation companies. We have a fourth pillar, which is called Emerging Frontiers, which is around new technology platforms, new problem states where we think big technology businesses can be built. And so we're always remaining curious and exploring new areas. We're really fortunate. We were, if not the first, then one of the first investors into all these companies. There may be companies on here you recognise. They may not be, and that's okay. We're founded out of Victoria. We're proudly from Melbourne, but also have offices in Sydney and a presence also from time to time in Queensland. So we do invest across Australia. Abby's actually based in Sydney, as is a lot of our investing team. So in these businesses, and there are a few others not on the chart, where we were the first investors, and we've really helped those companies, not just with cash, but really to try and set the business up for success. Sometimes that's establishing a board, sometimes that's getting good lawyers. Anthony is our primary referral path, getting the infrastructure for success built out and building that pathway to follow on. So Really, because we're not a multi-billion-dollar fund that goes, we'll be your seed investor through to your Series E. One of our primary objectives is to really align with the founders and what is our capital pathway moving forward. How do we achieve the kinds of, or help the companies achieve the kinds of operating metrics and the right relationships to have that pathway to the right capital. And it's really, really nuanced. It's probably, I only get a chance to touch on it today. What is the right kind of capital? Venture capital is this big amorphous mess. Actually understanding the nuances and the segmentation and who's right for you. It's not just a matter of who will fund you, it's who's actually most valuable to you. And that starts to become clearer the more advanced the company becomes. And there are companies, there are funds and there are investors who will really add value, and there are companies or investors who really might not. And helping to understand that is one of our jobs to do with supporting the companies we invest in. As we go in so early where it's still all to play for, is actually building the operating success or supporting the building operating success, but also building those funding pathways. So we feel like we've done this. Well, I said we feel really pleased to be here on this topic. It's something we've done a lot. As Anthony said, I had 20 odd years in working with startups in the US and in Europe before starting Rampersad. So I don't know how many rounds of capital I've been through, but certainly hundreds. Got a bunch of battle scars. I'm very lucky to have had a fair bit of success, but also probably learned a lot more about the things we've messed up. And we try and bring that forward and, as we say, make novel mistakes together. So that's the context that we're coming from. Abby, I think we can skip through probably to your slides. I'll go back on mute. I'm here, but please just encourage you to put your questions in. I'll answer that very, very quickly. We are remunerated in two ways. Every VC fund is the same. There's a fee that we charge our investors. Typically, that's 2% of their committed capital per annum. Sometimes goes up or down from that. And that's generally the money that keeps the lights on. That's what pays Abby's salary and the rest of our teams, and pays for our rent, and that's about it. Where we really make our money is on the, it's called carry, so the proceeds of sale. So what we say to our investors is once we actually get liquidity, so we sell a company or we sell our shares in the company, or then we get 20% of the profits. Basically, that's you might hear it referenced to 2 and 20. So 2% management fee, 20% of the profits. Typically, that has a performance hurdle, so it's not just a profit above zero. It's typically a profit above. In Australia, it's typically between 5 and 8%. But that's really how we make our money.
Awesome. Thanks, Anthony, for trying to make sense of my weird and wacky background, and Paul for the kind words about the content. But I guess to sort of reiterate Paul's initial point around sort of the fundraising process and that journey, it's very much a bespoke sort of thing for different startups. Some people might be able to raise in a week. Some people might take 6 months to a year to raise their first round of capital, or even subsequent rounds of capital. So I think sort of going into this presentation, it's important to sort of take what resonates with you and sort of leave the rest behind. And I think it's like really, really important to like consider your own context when sort of applying the information that I'm going to talk through, because a lot of it is very much subjective. Like investing in early stage startups is very much a subjective process and a play, and there's the sort of objective ways of doing it, and we certainly try to be quite objective, but at the end of the day, everything is sort of driven through subjective measures. So I think that's the first and most important thing to sort of highlight around all of this stuff, is that the founders that I sort of speak to, a lot of them are confused a lot of the time as to why a certain business has been able to raise the amount of capital that they've been able to raise. And very honestly, like a lot of the time it's confusing to me too as to why some businesses are funded and some aren't, right? But at the end of the day, it's the investors' sort of subjective opinion as to which startups they want to back and which startups that they want to invest in. So just keep that in mind while we're sort of talking through all of this. I'll share my screen again to sort of run through the rest of the content. Here we go. So I think for this presentation, we'll sort of cover off the three sort of main things that I think about when sort of thinking about the pre-fundraising piece, but also the early stages of fundraising, because I think those are the sections that can actually be codified a lot. Once you start going into the fundraise process, a lot of that turns into very much a bespoke thing where different funds will ask for different information and sort of have different processes in terms of how they assess a startup. But at least the pre-funding piece will be quite similar for most businesses, and the start of the funding piece will be quite similar. So we'll sort of cover off these three things. One, deciding whether VC is the right funding source for you and what that actually means. Two, how you can actually logically structure your pitch deck to tell the best story possible. And three, how you can actually structure a fundraise to ensure you get the most out of it. So I think to sort of expand upon that third point a little bit more, fundraising is somewhat of a art, not really a science, but we're trying to turn it into more of a science with that piece. So I think that's probably the most practical part of this presentation, but the rest will be pretty useful as well, in my opinion. So starting off with what VC investors are really looking for, I think you probably would have heard that a lot of investors just sort of hark on about the team, or the people behind the business. And that's by and large the most important thing when making an early stage investment decision is, are these the right people to be building this business? How has their past sort of led them to building this business, and how are they best placed to actually build a unicorn business? I think that, like, when we sort of think about markets, we think about products, and we think about go-to-market strategy, all of that largely relies upon the people actually executing upon all of that strategy, the vision, and who have the ambition to actually grow a company. So that's by far the most important thing. And so when thinking about how you actually tell a story, it's very much largely about the team. The second thing to really unpick is VCs like to invest in painkillers. Painkillers are typically things that people rely upon and they definitely need to have, rather than a want to have, which could be a vitamin. So I think that's a pretty easy distinction to make when thinking about your problem statement and the solution there. The third thing is sort of around the uniqueness of the solution. So the best businesses are able to build unique moats and innovate on different facets of their business. So it's really important to think about what makes your business unique, what makes it hard to replicate from a product perspective, what moats you're building over time. At day zero, you're not going to have any moats. Like, very realistically, people are your biggest moat because that's what's unique to your business. But over time, how are you building the moats, and how are you compounding on the work that you've done in the past to build a better product in the future is really important to understand. The fourth point here is around progress. And so what I find a lot of early stage founders are at is they know where they need to go and they know what needs to be done, but they don't necessarily know how to measure it from a KPI perspective or from a metrics perspective. And this isn't just revenue. It's sort of thinking about user engagement, thinking about the incentives that exist in your product that drive certain product behaviors and actions from a user. And I think it's like really, really important to understand the metrics, I guess like the North Star metrics for your business. The fifth thing here is having a huge vision, and going back to sort of that vision and ambition that the core founding team typically have. It's like, how big is that vision? So in like 5 to 7 years time, what type of business do you want to build? Is it a business that's sort of making $10 million ARR a year? Like, that's great for you. But from a VC perspective, we want to make a lot of money. And so to Paul's point, a large part of our remuneration is purely on the 20% profit that we make. And so we're looking to maximize that profit piece. So we want to make everyone money. We're not really a charity. A lot of people seem to think that VCs try and make a huge impact in the world and are largely sort of donating money, and that couldn't be further from the truth. I think sort of high impact or huge impact sort of businesses are really, really valuable in the fact that they make everyone money. And so that it's sort of like looking for businesses that do both is the holy grail, I think. And then the last point on the slide is very much around the why now. So like, what do the market tailwinds sort of look like in this business? I think, you know, a lot of startup ideas aren't necessarily unique, but what is unique is the time in which they're built. So for example, the idea for Airbnb like has existed since the 2000s. Like, people were trying to, you know, rent out rooms in their houses and like spare beds and all of that stuff. But around that 2008, 2010 sort of period, that's when the timing was right for that product, where there was enough trust in strangers to go and live in their houses and all of that stuff. So timing really, really matters. So moving along, like
Abby, just a quick question. Just sorry to
Yep.
interrupt. Just from David Buckley. I know Paul gave a bit of a profile on what you guys are looking to invest in, but do you ever look at businesses that have been in existence for longer than 12 years and looking at that kind of with an Australian base, but looking very global? I know that you were deploying money into Australian companies, but is that also fitting within what you guys look at? And
yeah, it's a really good question. So we definitely do look at businesses that are somewhat like early stages, being sort of grown in Australia and definitely looking to sort of grow overseas. I think what we've found is that, and what I'll touch upon on this slide, is that the Australian market is somewhat constrained in some perspective. In some cases, they're pretty big, like in the fintech space, very big market. But if we're sort of thinking about it from a consumer angle or from like a niche perspective, it's quite small. So we typically find that businesses to actually return a venture scale outcome, they need to sort of expand overseas, is sort of what we find. On the piece around 12 years or a mature business, let's call it, I think what we find is the businesses that we typically back have sort of been in existence for anywhere from like a year to 5 years. Typically that sort of fits the early stage mandate. 12 years would make us consider like why now for the business. Would actually have to be quite clear on what the capital pathway has been for the company and sort of unpick what the future looks like for that business. Like, why have they been around for 12 years? Why haven't they hit the successes that we'd normally be looking for? And what's actually changed going forward? And why do we believe that now is the right time for this business to really achieve hyperscale growth? Does that sort of answer the question?
yeah, absolutely. No, that's great. Thanks for clarifying.
Cool. And to sort of like unpack that, because it's an interesting point, I think venture investing sort of works on a power law outcome basis. So what that actually means is that for every investment we make, we need to be able to return the full fund with that investment. And so to like make that even more practical, if we sort of had a $10 million fund, we make 10 investments, each $1 million, we'd need the payoff for each of those investments to at least have the potential of returning us 10 million bucks back. And so that could mean different things depending on the entry price that we're getting in at and the exit price that we're sort of selling our stock in the business at. But effectively, what that typically means in like even more practical terms is we basically need every business that we invest in to have the potential of either being anywhere between a $500 million business to $1 billion business for Rampersand specifically. For different funds, this return outcome will sort of change, but for Rampersand, we're a smaller seed-focused fund. That typically means we can accept, I guess, anywhere from 500 to $1 billion outcomes as really strong outcomes for our fund. And so to really achieve that scale of outcome, what we need to see in a business is that the business is sort of operating in a large market that sort of has the scope to grow even further and faster in the future. So we're sort of looking at the tailwinds, we're looking at the current state of the market, and we're sort of looking at the level of competition that sort of exists in the market. We effectively are banking on the fact that the companies that we invest in can become a monopoly in the markets that they're operating in. It's typically really hard to have a venture outcome with a duopoly or in sort of there's multiple sort of winners in a certain market. We sort of have to back the fact that the investments we make will become the single most important company in that market. And then the third thing that we sort of expect is very much the fact that the companies that we invest in will be able to grow really, really quickly from a revenue perspective. And so there's a common framework that's sort of applied in venture mathematics that's called triple, triple, double, double, double. And what that actually means is after you hit 1 mil ARR, your revenue triples twice over 2 years. So you go from 1 to 3 and then 3 to 9 across 2 years. And then from then on for the next 3 years, you're sort of doubling your revenue over time. And so by being able to do that, you sort of, if a company can do that, they will easily hit a unicorn status from a valuation perspective. And those are the types of companies we're looking for. So we're looking for really large markets that are growing really fast, that allow companies to grow on the coattails of a tailwind. and also grow really fast in a fast-growing market. And I think there's not a lot of markets in the world that exist like that. At the moment, AI is the closest thing to sort of being that. And I think we're sort of seeing $100 million outcomes sort of every day in that market, where I think GitHub's Copilot product specifically was the first AI business that sort of hit $100 million of ARR over the last year or so. So it's still very nascent in AI, but across different markets, yeah, it can fluctuate from a growth rate perspective. So moving along, we can sort of have this framework as to like how you might want to judge your business to see whether it's actually scalable, it's actually able to become a monopoly in your chosen market. So we're sort of looking for zero marginal cost. So the cost to create and deliver another unit of product and generate more revenue is zero. So for software businesses, they're typically zero marginal cost businesses. There's zero transaction cost to sell and onboard customers. So typically PLG type businesses sort of fit the bill here. We're also looking for infinite leverage, where there's ability to sell to anyone and anywhere at any given time, so all over the world. And we're also looking for products that can improve and embed themselves in customers' workflow, customers' lives, and all of that over time. So we need to sort of see that compounding advantage over time. And the last piece is ecosystem creation. And this is an interesting one in the context of Netflix and Airbnb that we have examples on the side, is that we're looking for businesses that can create an ecosystem around themselves and sort of be that monopoly. So I think Netflix for a period of time was definitely a monopoly in the streaming world, but very quickly they were competed against by traditional networks. And so we're sort of seeing a very competitive market there, which sort of reduces the attractiveness of Netflix as an investment, whereas Airbnb is still very much a monopoly in the home rental sort of space or the short-term rental space. And so they've been able to create an ecosystem. Whether that's threatened in the future remains to be seen, but at the moment it's sort of holding its own. So that's sort of what we're looking for, and that's a quick framework that you guys can apply on your own businesses to see whether it is actually suitable for venture investment. I mean, there are other types of investment, but you know, I think if you're sort of looking for those, there are better people to talk about that than me. So sort of moving along to the second point that I sort of spoke about at the start from the agenda is around how you actually go about structuring your pitch deck. And so to sort of preface, people have different templates and different styles of actually messaging or storytelling their business. This is just one suggestion that I think works really, really well and sort of fits what a venture business looks like and tries to hit what VC investors like to look for. So the first and foremost thing to remember with all of this is a pitch deck doesn't necessarily make you money in any way. Like, it opens doors, but it doesn't secure an investment by itself. I think that's like really important to understand and something that a lot of people mistake. And so what you're trying to do is you're trying to communicate your story in a way that's one, enticing and exciting for an investor to take that first meeting and to actually like spend their time doing some due diligence on your business. To sort of put it into context, I think as early stage investors, Paul and I sort of see anywhere from 800 to 1,000 startups every year come through our doors. And so that's sort of 800 to 1,000 pitch decks that we're looking at. And very honestly, not a lot of them are that great. And so if you can actually make a really good pitch deck, the bar is quite low in terms of like what constitutes a really good pitch deck versus a bad pitch deck. So having a logical framework, having a logical flow is really, really important. But it is definitely more art than science in terms of how you might go about doing that. To sort of give you a better framework for this, I sort of think about the pitch deck in sort of 6 stages. And you can sort of see the 6 on the right-hand side of your screen, where it sort of starts off with market context and opportunity, moves on to go-to-market strategy and business model, followed by product features and roadmap, then traction, then team, then the ask. And so starting off with the market context and opportunity section, I think this is by far the most important section because it actively states the problem that you're targeting and the opportunity or the scale of market that you're going after. So you would sort of put your typical TAM slide in here. You would put any details around your market tailwinds and all of that stuff here. So what you definitely want to be sure of showing is that there's a large and growing total addressable market, but then that market is actually growing at an exponential rate into the future. And so the demand for your product will then sort of ride on that tailwind going forward. And so that's like the first check as a VC investor that we'd look for, is that the market is big and it's growing really fast. From here, the rest of the narrative sort of falls into place. Given the structure of the market, your go-to-market strategy is important. So I think there's like a common adage where it's sort of like first-time founders focus on product, second-time founders focus on distribution. You can have a really, really strong product. You could have the best product in market, but without the right distribution channels and sort of strategy, it doesn't really matter. Like the second best product will win if they had the first best distribution. And so that's why I think it's really, really important to actually lay out what your go-to-market strategy is and what your business model is and the incentives behind why people will adopt your product. Before you even talk about what the product actually is, it's important to actually talk about how you're going to sell it and who you're selling to and why that makes sense given the current market context and opportunity. And so then from there, then you actually talk about product features and what the actual product is and the roadmap for the product. And so why I put that third is very much that, for example, if your go-to-market strategy is product-led growth, that means your product will be built in a certain way that aligns itself to being sold in a product-led growth manner. If it's an enterprise level product, there will be different onboarding features. There will be sort of different functionality and workflows and security certifications that are required to be sold in an enterprise context. So the go-to-market strategy matters and who you're selling to matters before the product is actually built and communicated and all of that stuff. Following on from that, both of that tie into what the traction looks like. So early stage company building is all about hypotheses and testing and experimenting based on these hypotheses. So as early founders, you sort of have a hypothesis on who would actually be curious about buying your product or who would be using your product and what features they sort of would want. And you want to show through your traction the success of the tests or experiments that you're running to test out these hypotheses. And so that's really in your traction slide, which is why it comes forth in sort of the sections. And then following on from that, you have the team composition and hiring slide, which is sort of like the thinking there is very much, we've achieved all of this with a small team and we've achieved this traction, which gives us the right to hire X number of people with this funding round, or sort of we want to hire 5 engineers to further build out the product and actually execute on the roadmap and things like that. So that sort of comes fifth. And then finally, you sort of round out the deck with your ask. And we'll sort of go into that in a bit more detail around how you actually think about your ask and how you actually think about structuring it. Because I think this is one place that a lot of founders leave I guess like a lot of founders just take a very simplistic view. I think you can actually take a granular view and stand out amongst the rest of the founders that are sort of pitching in this sort of segment. And so from an ask perspective, the current norm or sort of the common way of thinking about how much you should raise is one, just sort of picking a number out of thin air, and it's like, oh yeah, maybe $2 million would work for a pre-seed business, and we sort of think we can get around 24 months of runway. There's not much science that's sort of involved with that, whereas I think you could be a lot more granular with your ask, and actually being granular with your ask means you can maximize the dilution that you're taking on with this round, but then also two, you can show the VC that you've thought quite carefully and heavily about your business, and you sort of build up a lot of trust if you're able to do that. If you can show if you can show a VC that you're a logical thinker and you're a hyper realist, I think that goes a long way in terms of securing capital. And so that really starts with how granular your ask is, how clear your future plans actually look like for the 24 months that you're sort of raising for. And so the way to sort of think about it is in sort of a jobs to be done framework. And so on the left-hand side of your screen, you can sort of see a quick graphic where it's sort of at the seed round, your job to be done as a as a business builder is to build the product and find product market fit. At the Series A, it's to hire a small team and grow your revenue further. At Series B, it's to scale the team exponentially and keep growing revenue. Series C, it's to achieve and maintain profitability. And then at Series D, it's to continue growing while staying profitable. That's what I think the jobs to be done at each fundraising round actually are. Different people will have different opinions on that, but that's just my view. And so if we're sort of thinking about what build product and find product market fit actually means for a seed stage business, the ask for that will be quite different to an ask for a Series A business. And so you need to actively and accurately cost out how much it would take to build your product, whether that's 3 engineers or whether that's 10 engineers required to build the product. But that's all you should be looking to achieve with your seed round. You shouldn't be looking to hire a bigger team than necessary or grow your revenues like crazy, because it means that other parts of your business will lack. So by being quite focused about the outcome or the job to be done at each fundraising round, you can actually be quite granular in terms of how you think about your ask. And so,
I mean, just a quick question. Sorry to interrupt, but we just had a question from John Delaney, which I think is relevant around this part. He was just highlighting that, you know, Netflix went $50 million into debt before really making gains, and you know, you guys are looking at that kind of 500 to that 1.5 mil at that stage. How are you seeing? One of his questions was just how does a company take that $1 million investment and get it out of that early stage piece? What have you? I mean, I think it'd be great just to hear some examples of how you've seen companies successfully do this, and you know, you even said before, just kind of keeping it pretty lean, I suppose.
I think the important thing here to remember is that, like with this ask section, it's very much in the context of the market that you're building. And so different companies will have different capital requirements. There's companies in our portfolio that require millions and millions of dollars to sort of sustain operations and grow it. Sendle being one of them, which is able to sort of, which requires a lot of money and is capital intensive to be able to achieve the mission in which it's sort of going on, and sort of achieve like really strong revenue outcomes on that side. Whereas there are other businesses, predominantly on the SaaS side. So we've got a fair few SaaS businesses that sort of do $2 million funding rounds and are able to sort of achieve $2 million of ARR on a pretty regular basis. And so it really depends on the context in which you're building. If you're building a consumer business, it will take a lot of money because you need to do a lot of marketing. There's a lot of time spent in building the product. You will need a bigger than normal team. If you're building a software business and your co-founders are largely technical and business orientated, then you probably don't need a huge team at the seed stage. You could probably get away with just having a few other engineers and maybe one salesperson to actually figure out what product market fit looks like and to scale your revenue. There's a business that we've invested in recently that has just hit $1 million of ARR. And in the history of the funding, I think they've only raised $3 million in funding across 2 funding rounds. I think that's quite rare given the last couple of years where funding was quite open and sort of free, like honestly quite free. But in going into the future, I think funding will be a lot harder to come by. And so capital discipline is super, super important. So again, like it's hard to give like a general answer for this, but it's very much in the context of your market, in the context of your product, in the context of the opportunity. Like think about what the bare bones way of sort of achieving product market fit actually looks like and cost that out accurately. And you'll find that it probably doesn't cost as much as you think it would if you just took like a sort of general approach to doing it.
And
So,
probably
like,
also just actually making sure it has product market fit as well.
Yeah, like that's another thing where it's sort of like a lot of founders think they have product market fit. Realistically, they don't necessarily have that because there's high churn or they're not able to sort of expand revenues, but they're not tracking the metrics that are required to sort of show their success. And that goes to one of the first things that I sort of said. It's important to have North Star metrics that you're tracking and that actively and accurately measure your success. Does that sort of answer the question?
Yeah, no, absolutely. And don't worry, I've fallen foul of in my early days of founding companies and thinking you found product market fit and had some tough love given back to me, but it was very beneficial. But that's great. Thanks, Abby.
I think it's
sorry,
Yeah.
I was just going to jump in. I mean, like, just for everyone watching, listening to that and go, well, what do I know? What is the number? What is the point? What is the metric? What is the, this term that we use of product market fit is really hard. And why Anthony's saying he thought he had it, and Abby's saying some founders think they have it, they don't. It's because there's not it's not a black and white answer. There are lots of things that go into it. It's different for every company. So if you're sitting there going, well, if I find this magic fairyland and I've reached it, then everything's wonderful. Apart from the fact that firstly, you've then got a whole lot of scaling challenges you're then going to overcome, which is, to Abby's point about each stage unlocks different challenges. It's also not quite as clear. So the best advice to give at this point is, firstly, understand it's not a metric, a number, a moment. It's a combination of things that's unique to your company. I feel a lot of people say the only way you know when you've got product market fit is in hindsight, when things just started to become easier. The great thing in Australia now, as opposed to the early days when we started, is there are more and more people who have been through it, either as investors, as founders, as employees, as operators. So just make sure you've got people around you and they're asking you the question, you're asking them the question. So don't imagine it's just going to pop up. Don't imagine that the answer is going to be clear. It's going to bash you over the head when you got it. Do surround yourself with people who have been through it and can help you sort of unpack the mystery.
Yeah, it's good advice. But yeah, I just noticed the time. I haven't gotten to my third section, but do we want to open for questions? Should I keep going? What do you guys think?
No, I think we're all good, Abby. Like, I mean, I'm not sure how everyone else is placed. Obviously, I can go over. I'm not sure how you guys are placed as well, but please continue on. And guys, if there are any questions, please field them. I'm seeing them all, and I know where parts of the presentation are going, so I'm trying to fit them in as appropriate. But yeah, please continue on.
Cool. I think that's sort of the use of funds, or the ask section, sort of covered. Sort of moving along to the third point of my agenda is very much around how you actually structure the fundraise and how you think about this with a product lens to actually your pitch. So I think a lot of founders, like, the common way of fundraising is very much, oh, I know 10 investors, let me hit up all of them, email all of them, schedule meetings, and we'll go through that and we'll see what happens. It's a very like spray and pray type of approach to fundraising. I think you can actually be a lot more methodical and a lot more nuanced with how this actually works. So the quick way of thinking about this is very much in an iterative fashion. So how you should think about structuring it is very much, you have your list of sort of, let's call it 100 investors that exist. You want to figure out how you can reach each of those investors, and you also want to think about how you can actually like rank and prioritize these investors based on whether you want to actually work with them, whether they fit your company's sort of problem area, whether they have expertise in growing a company like yours, whether they've worked with companies like yours or in your industry or your segment. There's a whole bunch of things that you can look for from an investor. So rank and prioritize in sort of 4 different tiers, and then sort of think about it from a perspective of, don't pitch the best investors first. Pitch the investors that you don't necessarily want to work with, but you want to get feedback from them. So pitch them first, get all the feedback, get practice on them, make mistakes, do all of that sort of stuff with those investors, collect all the feedback there, and then iterate on your pitch over time. So you'll sort of see the template schedule on the right-hand side of the slide, where it's sort of week 0, reach out to tier 4 investors, schedule meetings, practice on them during week 1. And then for week 2, practice again, iterate on your pitch, and then reach out to tier 2 investors, go and pitch them, see how they go, and then sort of work your way up until sort of the best investors that you actually want to work with. And so the goal is very much iterate like you would a product, and sort of build on your pitch, get confidence in your answers, ensure that you know the red flags that VCs are looking for, ensure that you sort of can handle any objections that sort of come out, and can sort of address any tricky questions that might come out. Because I think investors like to think that they're special and like to think that they ask really unique questions. A lot of the time they probably don't. So by practicing early, you can actually get the questions ahead of time, and it's sort of like semi-cheating on a test potentially. So it's sort of like you get the questions that the tier one investors will ask you, and you can practice and hone in on your answers there. And so then when you actually pitch the tier one investors, you're sort of on the right track, and you can sort of nail the answers and impress them and hopefully get a term sheet out of them. I think that's like the quick and easy way of thinking about fundraising, is an iterative approach that you would with the product. Sort of do a lot of practice pitches, test your pitch deck on a lot of people, and go at it that way. But yeah, I think that's the important thing. I think it's very important to sort of talk to investors early in the journey, get their view on how you're building, get their guidance, understand the language that they use a lot of the time. So I think when you're thinking about storytelling your business, the language in which you use actually matters. Investors sort of talk in a way that can be quite foreign to founders. And it's something that investors are really used to, because they sort of, as Paul said, we live in this day to day, and it can be a little bit of BS. But as founders, you have to understand and accept that BS and then play the game, right? I think that's the most important thing. And a lot of founders aren't able to play the game, which makes the fundraising process a lot harder than it normally would be. If you're able to use investor terminology back on the investor, it sort of signposts like, oh yeah, they know what they're talking, like the founder knows what they're talking about, or they just kind of get it, I suppose, is one way to think about it. And so in this, we've sort of got what gives investors the ick. It's like, don't use buzzwords that don't reflect your product, like AI, ML, blockchain. Actually understand what that means and whether it actually fits with your product. Don't sort of say you're the Uber of XYZ. There's a whole bunch of don'ts here. So I think it's like understanding this, understanding what you should say, and then figuring out what your story actually looks like. And the only way you can do that is if you actually practice on investors that don't matter to you, and then going at it from that perspective. But
I'll just come up with one point of clarity. Don't include Abby in that list. He should be the first person you go and talk to.
Yeah, it is true that. Yeah, but that is a really good point though, Abby. Like we encourage a lot. We use that similar analogy for our clients when I always say it's like the comedians. They'll go and do those small 10 to 20 person where they'll do stand up in the back blocks of LA before they get onto the real big stages of Hollywood Bowl or Saturday Night Live. And that's the big guns. That's where you want to get to. But if you can kind of do those small theaters beforehand and build up your pitch, and you'll be in good position once you get to the big leagues.
Yeah, exactly. But yeah, that's how I think you should think about structuring a fundraise. A lot of people leave a lot on the table here. There's a lot more juice you can extract out of this process, where it's like, even if you aren't able to raise capital, you'll learn a lot about your business because you've surveyed so many people, or you pitched so many people, and they've all given you their advice. It's up to you to take that advice or to not take it, but it's important to collect the feedback to see how other people are thinking about it. But yeah, that's sort of the main presentation done. We can sort of open it up to Q&A from here.
Abby, that was awesome. Thank you so much for that. I've got some absolute great notes here as well, particularly around, I love the logical thinking and hyper realist. I think you can wait to see that in the post. I do just want to go just before. I'm sure there are a number of questions going to come through, but I think one of the things I wanted to talk about is making like Paul, you highlighted it early on, and so did you, Abby, just about when the timing of a VC, and there's always a lot of founders can get deflated with being knocked back, and it might not be the right time for a VC. But are there times when it's just you guys might have allocated more, and the entirety of your fund, or there might just not be money available just yet to allocate, as opposed to it's not necessarily the business that you're, or will you guys just always find a way?
Let me sort of unpack the question a little bit. To say, when is the right time to make the approach?
More around if you're deploying money, if a founder comes to you to pitch, it may not necessarily be that the business isn't appropriate to be invested in. It might be that you guys have allocated all your money, or you've got a certain portfolio that is tipped towards a certain marketplace or a SaaS product, and you kind of, within your investment criteria, you're looking for something different to balance out your portfolio? Because I think that's an important piece for founders to know. Or is that the case?
Look, so let me probably, it does change by stage. So we're obviously an early stage fund, as we've covered. We'll typically do the pre-seed or the seed round and maybe the A round. And I know that there's an overlay here as part of this webinar series is about getting into the US. And so one of the things that Anthony, to really try and unpack the question is, who do you talk to and when? As much as I think you're saying, what's the danger in talking to too many versus too few? What we'll say is raising US seed from Australia is really, really hard. And what we're seeing, and it started to open up a little bit during the boom times, but it's gone back again now that things have tightened up. And typically the US investors that, we have a lot of them in our network. One of our colleagues, Hunter, just came back from the US last week, and he met with 30 over the week before. I was in the States last week. The consistent message is, we want to see you at Series A+. We want to see you with boots on the ground. So I just want to, so what's really helping raise money in the US is when you've got Australian seed that's well respected and well networked and can open those doors, help answer a bit of that question, which is who to talk to, help refine the target list. So to then say, well, what about doing it in Australia? Understanding probably two broad things. I think Abby touched on some of it. Firstly, it's really hard to tell who's writing checks and who isn't. I think like most Australian VCs raised funds over the last couple of years and have deployable capital. So in general, to get your early stage capital in Australia, you'll be talking to funds who are deploying. As to whether you fit their mandate, that's like, there's a bit of research to be done, and most funds are pretty good at being open about what they invest in. Like you've just heard from us, there are 3 core areas that we're exploring. There you'll see the content from Abby and others around which areas they're exploring. So it's not just about which fund, but which investor is best targeting, is best to target. So try and triage your target lists as best as you can from public information, but also, I think Abby mentioned this before, do some referencing as well. Like the best resource to go and figure out who you want money from is to talk to other founders, and understand. One of the questions to ask them is, what were they like when things went wrong? Just a little tidbit, because everyone's great when things go well. Back to alignment. So point one. The last, probably, Abby, you might have to add. Getting a no is just part of the business. And there's a billion reasons why you might get a no. It might be like Anthony said, that has a conflicting investment, and they're a fund that just doesn't have 2 competing companies in their portfolio. We're one of them. If you've got our money, you've got our heart, you've got our desire to win. We're not going to take 2 horses in that race. We're going to back 1 horse. But so other funds have differences. It might be the partner just didn't feel it. It might be they had a bad experience with a similar. Like there's a lot. It's a very human thing. So no's, it's very personal. So I don't like it when people say don't take it personally. It is personal. It's not the be all and end all. You're going to get a lot of no's in this business. The best funds, and we try and do this, is to say, like, it's not for us. Here's the reasons, and here's a few people who you might want to chat to. You can expect that. You might not always get it. I'm probably setting the bar a bit too high. One of the reasons why VCs don't like giving you a lot of information in the reply, you might hear things like, "Oh, you're too early." It doesn't fucking mean anything. Sorry for swearing. It's just a personal perspective that someone couldn't be bothered giving the answer. The reason they do that is because I don't want to get into a long, protracted debate. They've made their decision. You're probably not going to change their mind. Don't bother. Maybe give it 1 more round. If you're desperate to have them in your round, give it another bit of justification, but don't engage in long, protracted debates. That's what people are afraid of, because you're not going to change their mind. The other is they want to create optionality for when they want you to come back. It's no, but it's kind of a no, not right now. So what you'll hear a lot, Americans do it a lot, Australians are starting to, is to say, "Oh, we love everything about you. It's not quite ready for us. Keep coming back." Because you just might shoot the lights out. So you want to come back. So don't be afraid to have the conversation. Do the triage work up front. and don't take no's too badly. It's just another road on the journey. I don't know if that answered your question.
No, it did, and thank you very much. But just on that, I just had a question, and Abby, you raised it in your presentation as well, just about the kind of that self-deprecating Australian when they're pitching, and I know Paul as well. You've kind of highlighted it as well, and I've seen it firsthand in the US as well, where that kind of although Australians are how are Australians perceived globally, I think is a really important first question. But what are some of the things that we can also be, looking at that doesn't work globally, like particularly from that self-deprecating and possibly that self-belief as well when we're pitching?
I think my take on it is that Aussies tend to be they sort of keep within themselves on the ambition piece. They're not like outwardly ambitious. If you talk to an American, they're not afraid to sort of tell you what they really think, or like tell you what they're going to do that changes the entire world, right? Like they have unbridled ambition, or it seems like they have unbridled ambition, and a lot of Australians sort of compress or hold that back because I think there's a fear of being judged, or there's a fear of being ridiculed, or whatever it may be. I think in a VC context, like, we're looking for people who have that unbridled ambition, or are able to sort of display it and showcase it. And that's frankly what's necessary to build a really big business, and to sort of build a team that's willing to eat shit for like 5 years and actually build an awesome, huge business, right? Like, you need a fearless leader who is willing to back you, but also dream big and sort of bring everyone else along for the ride. So as VCs, that's like something that I look for every time I talk to a founder. It's like, yeah, does this person have like massive amounts of ambition and unapologetic ambition as well? I think that's the most important thing that Aussies can sort of pick up.
Just to double down on that, like, it's a fine line. American, like, this unbridled overselling. I think that sometimes when we look at it from the outside, that's what we see from Americans. It's confidence, but it's also the ambition, like Abby's saying. When you start to undersell on the ambition, it's not to be overconfident. It's not to sort of like, what we don't like is when you come in and we got everything worked out. Like, you're driven and determined to solve this problem in the world. You are prepared to, I'll quote Abby, eat shit for a bunch of years on the way. Like, you're so determined to solve it. That's what we want to see. You're mission driven. You know how to sequence the growth of your business to get there, but you also recognize there's a lot to figure out. So trying to paper over that sort of baseless overconfidence is a real turnoff. But so is going, well, we don't really know what we're doing. We hope we can get there. We're really, we've got to get lucky. It's like, well, no, we want that. Aussies are becoming really good at it because we're not over presenters. We're not full of crap. We do recognize the challenges, but we just don't let that lack of confidence come across as a lack of sort of belief and determination. That's what is the undoing.
Yep. No, that's great clarification. And I think, given your experience, Paul, and globally, that's excellent. Just to understand that.
One of the questions on Robert's question. Oh, sorry, sure. Anthony, I'm doing my own triage. Apologies.
No, that's okay. I was going to actually ask you this. I mean, it is there's a bit of a legal part to it, but how do you protect your IP while pitching to investors? Is it merely a standard NDA, and is this ironclad? Can I just, before the NDA is one part, but I'd really love to get your opinion on what would happen if, because there's a bit of, from a industry perspective, it's not a very great practice to be putting forward an NDA to an investor. I know that doesn't go down too well, but I'd love to hear your opinion.
It goes down terribly, terribly badly, and I'll tell you why. So let me answer the question and tell you why. The way you protect your IP is to pitch reputable investors. Full stop, end of story. There is no legal document. There is no structure. Just pitch reputable investors. They will never steal your idea. Now, there's a couple of reasons behind why VCs will not and do not like NDAs. The first is we see lots and lots and lots of things, and you'll be amazed how much sometimes these disruptive ideas are like buses. Like, they just come along in groups, I've lost count of the number of times I've seen pitches from companies who are the only ones in the world doing it, but I've seen 4 that week. So just to tangle someone up in an NDA doesn't. It's impossible to execute upon because we just see so much, and just creates freaking. Not just our portfolio companies are working on stuff. You pitch something, we've got a company that's already working on that. Did we steal your idea? No, they've had it themselves. So reputable investors will not steal your idea for a portfolio company or for anyone else. They're not in the business of building businesses. They're in the business of backing founders. If you think that, I'm talking in general in the areas that we invest in, which is not deep tech per se. Deep tech is a slightly different thing. You've got to stage it slightly differently by building that trust, gating it, only revealing so much. In 99.9% of cases, the IP is not where the value lies. It's all in the execution. So the message that we sometimes get when a very early stage founder is coming to us and saying, please sign an NDA, and it's not in a particularly deep tech protected area, then the message that we're hearing is that you think all the value, the founder thinks that all the value is in the idea and totally underestimates the execution being the part where all the value lies. There's a session I do often with a Stanford business school professor who gives this talk, and he says, we've done all the research and we've actually quantified it. The value of an idea is about $1.50. And we joke and say, we think you're overpaying. The idea is not where your value lies. Again, caveat, if you are in a sort of patent-rich, deeper tech environment, it is different. And someone like Anthony can help guide you through that.
Yeah, I would say also, I mean, you're exactly right. Like there's not on the NDA and obviously the IP, but also one of the things that we're doing a lot more of now is, ensuring that they are credible. Like you've got to be doing your DD and your research on making sure that the VC is an appropriate person to be pitching to, but that doesn't necessarily just mean what types of investment amounts or industries or history they've got. It's also looking at the credibility of them within the market, and our firm has started doing a lot more of that kind of high level DD as just some advice before people, one, are either pitching or secondly, most importantly, taking money. And it is a big decision, because I think one of the great quotes from the movie The Founder is you don't want to let a wolf into the chook pen. So just be really wary about who you're bringing in and making sure they're reputable. That's right.
And that's talking to specifically financial investors. If you're talking to corporations, that's potentially different. If you're in an M&A process, again, different. But if you're talking to early stage VCs in sort of software marketplace data type businesses, then you'll find the executions where all the value lies. My apologies, I need to jump. I don't know how you're, Abby. But thank you very much for having us on. I hope that's been interesting. If there are follow-up questions, Abby's in my contact details. Happy for you to share them, and then they're public as well. So we're happy to keep talking. But I'll just say goodbye for now. Thank you.
Awesome.
Thanks, Paul.
Yeah. So just to wrap up everything, unless there are a few more questions for Abby, we have gone over, but thanks to Adrian again, and also Global Vic for the opportunity. I hope this has been a great webinar for everyone, and you've learned some things. We will send through our details as well. I believe, I'm not sure whether it gets sent around, but we'll put through our email addresses. If there's any questions.
Just to jump in, mate, I'll send a follow-up email to everyone that was on the call with a follow-up of contact details and the like, and basically a wrap-up email. And with that, once we've gone through and confirmed the recording and just tightened it up a bit, we'll send that through to everyone that registered as well. But if that's all from you, Anth, what I will say is just look out. We'll obviously have the third and final webinar in the series in a couple of weeks. So just look out for info regarding that in the near future. But otherwise, thanks for your time. Apologies for running over time, but we could have gone another hour, I'm sure. But and thanks again for setting that up. And Abby, mate, great presentation.
Yeah,
thanks again.
awesome.
No,
Thanks,
for
guys.
having me.
Thanks,
Thanks,
Abby. Thanks,
Awesome.
guys. Bye.
See you, everyone.